Morgan's Chief Economist Michael Knox. Thanks for your time today, Michael. True to form, the September-October period is often a period of concern or volatility in the Australian market, and this year's been no exception, led by the indecision by the Federal Reserve on interest rates. Just what is your interpretation of the true health of the American economy and what the outlook looks from here for global markets?
Well, the US economy is actually in pretty reasonable shape. It looked like it was growing, about 2.4% early in the year. And now we've slightly upgraded the growth estimate for this year to 2.5%. What seems to be happening is the low oil price has generated a slump in the minerals and petroleum sector, and investment in that sector is down by a third in comparison to the previous year. And that's knocked about 0.3% off the US economy this year. You would have had a good year otherwise, because there's residential construction, for example, is in pretty good shape this year. Now, what we think is going to happen next year is it's not so much that we think there's going to be a resumption in investment in the petroleum sector in the US, but it's just going to stop falling. And the result of that is that when you have that strong residential construction in the US economy next year, and also there seems to be commercial construction and hospital building also happening at the same time, then you get a US economy that's growing next year at about 2.8%. So that's really pretty healthy, and that's the best growth we've had in the last 5 years.
Okay, so looking for a bounce in the US economy. The other issue concerning investors is obviously China and its implication on global growth. What's your interpretation on the Chinese market?
Well, we've said in a number of places that what's happening in China has been misinterpreted, and a lot of the misinterpretation comes down to misinterpreting the data. The major piece of data which people are familiar with in China is the China Purchasing Managers Index for manufacturing, or the China Manufacturing PMI. And and when this number comes out, it's almost always misunderstood. In Europe, when they set the scale for these PMIs or PMI, Purchasing Managers Indexes, they set it so that 50 equals zero growth. And so most of the PMIs that are actually published are published about European economies, and that's what people are used to. They're used to 50 being zero growth, and below 50 is falling output. But in China, the PMI wasn't constructed by the Europeans, it was constructed by the Chinese National Bureau of Statistics. And they were, when they were setting it up, they were looking at a growth history where the lowest growth rate they had was 7% and the highest growth rate they had was 11.5%. And so they set the zero line, or the bottom of the scale, so that when it was 50 on the PMI in China, growth was actually 7%. So what's been happening is you've had PMIs for China coming out at numbers like 49.7 or 49.3, and the Europeans, particularly the European media, has been talking about this as China contracting, where in actual fact it means it's growing just below 7%. So what we think is happening is the Chinese economy is growing about 6.9%, which is still really good for the second biggest economy in the world, but there's a negative reaction to the number based on, gee, a bit of ignorance and a bit of misinformation.
And before, you've described the markets before as the outlook being aggressively flat. Since then, markets have fallen another 5 to 10%. What's your true outlook for the local shares at this price?
Oh, well, we think we started off with a fair value for the Australian market at the beginning of the year at about 6,000 points. And we had two very bad earnings seasons, and now our fair value is touch over 5,400 points. So it's come down a long way because of those earnings seasons. But the market's fallen a lot further than fair value, and it's 5,000 points, say, today. So we think the market is about 400 points too cheap. Sure. And normally what happens is we go through this tough period at the end of the year, and then we get to a recovery by January, February, and that's kind of what we anticipate.
Michael, thanks for your time.
Thank you, Tom.